Dhananjay Sinha, Head of Research, Economist and Strategist at Emkay Global Financial Services now joins us. Dhananjay, good morning. What do you make of the recent rally? Do you think it's largely a flow-driven rally, or is there a pickup in earnings and macros as well?
So I think earnings hasn't been that great yet. I mean, there has been a sort of a slow recovery in the past 2 quarters. This quarter, I think the earnings are going to be lesser. I think it'll be compared to something like 20% plus for for non-oil, non-banking sector companies that we consider for our universe. There would be a sort of a decline in terms of growth, but it is definitely a positive growth. Over the previous 5-6 quarters, there were sort of many quarters where there were contraction in earnings. So I think there is a marginal improvement. But I think as far as markets are concerned, I think a large part of it is driven by liquidity, I would say, and what's happening globally is also having a very significant impact on the domestic markets. And you see that many indices have actually been reached all-time high. If you look at the US markets, all of them have actually gone to an all-time high. And you also see a sort of a similar kind of buoyancy as far as fixed income markets and gold is concerned. So there is an all-round bloating of the asset prices because of the liquidity thing, and that has actually percolated into our markets as well, wherein the benchmark indices have done well over the past 6 months. And what we see now is sort of there is a permeation of that buoyancy into the mid-cap names, or also small cap. So there is a broad percolation of the sentiment that we are seeing. And from a domestic markets, I would say that there is a sort of a flow also that might be happening from domestic retail investors in mutual funds, etc. So I think there is a considerable amount of momentum that is feeding into the market momentum. And I think what has to be understood is that this is happening after the Brexit that happened, and also the fact that there has been more recently some increase in probability of Fed rate hike in September. So all those things, all those concerns are sort of scaled beyond, the sentiment is scaled beyond those concerns, and hence there is a considerable amount of buoyancy, I would say, as far as the market is concerned.
Liquidity, if it is here to stay, even if the numbers are in line, because markets have gone up, people have not revised their numbers on the higher side, you still feel markets would not fall?
So I think, see, the thing is, if the liquidity scenario continues to remain positive, and let's say if Fed hikes the rate, then also if the market remains buoyant and does not really moves on the downside, then I think that momentum can just continue. Of course, at some point of time, valuations can become very, very expensive. Currently, if you look at Nifty, it is trading at something like 23 times. And earnings estimate, if you consider in the calendar year 2016, if you look at some of the Bloomberg estimates, it is somewhere in the region of 18 to 20% for the next 2 years. My sense is that those will not realize. So I think somewhere down the line, as we near towards the end of the year, there will be certain realization as far as mismatch between earnings and multiples are concerned. But at this juncture, I think it does appear that the momentum is pretty strong. So I can't see a major trigger, I would say, beyond the possibility of Fed rate hike that can happen around 21st, 22nd of this month. That's the only risk I can see in the near term. I think subsequently, I would say markets will realize also that the earnings will still be downgraded for FY 17 and 18 as well. So I think that's where, as we move forward, there might be some concern there.
Let's talk about sectors and stocks. PSU banks clearly, are doing very well today. They have done very well from the Feb lows. If you would take a percentage, they would come among the top gainers. Have things fundamentally changed over there? Is anything on your buy list in the PSU banking space?
No, so we are still very cautious about the PSU banking space because we do not see them having the ability to actually grow. Their capital is still very quite impaired, and there is a significant requirement for them to be recapitalized. And in the future also, if there is a consumption-led growth and if there is a retail lending growth that will happen, it will be largely be coming from the private sector banks and NBFCs who are fairly active in this space. So I think PSU banks will still lag. As far as the current sentiment is concerned, I would say that the optimism for the PSU banks is coming from two aspects. One is that the GSEC yields have fallen because of interventions by the RBI in the GSEC markets, wherein it has been buying GSEC aggressively. So that is something that is seen as a positive for the PSU banks from a trading profit standpoint. And number two is that the government had recently come up with certain reforms with respect to infrastructure projects stuck up in government arbitration. So I think that's another point that people might be considering. But I would say both these things are very marginal in their impact. My argument as far as GSEC yields are concerned, the decline in the GSEC yield effectively mean that if you look at the PSU banks, they have highest allocation as far as excess SLR is concerned, and hence there is a sort of an opportunity cost they are running by not allocating excess money that is deployed currently in SLR into lending. So that's one thing that has been eroding their ROAs, and with lower yields also that stress with that opportunity cost will still increase. So the ROAs for the PSU banks will continue to fall, notwithstanding the fact that markets might be reading declining yields as a positive from a short-term standpoint, especially through trading profits. So I think my view on the banking sector broadly remains intact.
Just for the PSU banking space, say if there is a big merger, we're talking that largely reports suggest that we would in the end just have 5 or 6 big PSU banks with merger of some of the other ones. Don't you think it will lead to a lot of efficiency into some of the big banks?
See, I think integration of the banks will take a long time, and first you need to integrate as a principal argument, and then you will have to implement that. So implementation would imply removing duplication of activities across departments, across branches. All those things will happen, and there is a union that will need to be tackled as well. So it would take a fairly long period for that integration to happen. Now, per se, the consolidation does not necessarily translate into better efficiency. I think unless it also incorporates a sort of improvement in practices in the way governance is actually done, the way PSU banks operate, unless those also happen along with the consolidation, it doesn't really translate into that much of efficiency. See, the overall consideration with respect to asset quality and capital requirement would still remain. Even if you merge banks, it doesn't really resolve that problem at all.
Good morning, Mr. Sinha. This is Anindya from the Delhi studio. I just have 5 minutes to wish you good morning because we are at 11:55 right now. Just wanted to get a sense from you. I want to just go back to the markets, overall markets. And, we hear big investors, people who are market watchers, market analysts, fund managers, always tell you that we look at stocks, individual stocks where there is a value. We don't look at the markets overall. We don't look at looking at the overall markets is meaningless. But when you go to the individual stocks, you find that the stocks which appear to be overvalued are the ones which are getting bought every day. It's not as if they're suddenly correcting or they're stagnating and something which has value is getting bought into. So who's buying if the big funds, if smart money is not buying overvalued stocks?
See, I think you have to really look at the segmentation as far as investors are concerned. So you have a big FII flow that is determining the broader the benchmark stocks, and then you have some of the local players, including the mutual funds, insurance companies. Then you have the HNIs and the retail lenders in that order. So what appears to be happening is that if you look at from February onwards, when the market started to bounce after a 17% correction in the previous 1 year, it was led by the benchmark the stocks and largely driven by improvement in FI flows. So large cap companies actually responded very strongly, and within that also it's the same set of companies who have sort of earning visibility and on which they had invested earlier. They again come back to the same sort of stock. So that's relevant from all the consumer space that we have seen, auto segment also that we have seen similar things. Also within the banking system, also we saw that there was a considerable focus on private sector banks, and within those as well, the market actually differentiated between the retail lenders and the wholesale and the corporate lenders. Once that phase is over, that creates a sort of a valuation arbitrage for the mid cap, and you saw domestic investors, especially the institutional investors, chasing the mid cap companies, and following which we saw a sort of outperformance that was happening with respect to small cap and small mid cap companies, which had corrected almost like 56-70% by February from their peak. So what we are now seeing is that a broader permeation of this momentum, and we see mid cap, small mid cap and small cap companies actually doing significantly well, and those really multiply very sharply. So I think that is how one should really look at it. It's a progression of multiple expansion, and that sort of is coordinated with the flows that we see across different types of investors.
But it's, I'll just take some, look at my colleague Pankaj. I'm an armchair stock market anchor who really does looks at the numbers and the financial statements and then asks you experts questions about it. But Pankaj, my colleague, has his ear to the ground. He's a khabri that we call. He picks up what is up, and usually each day the questions he asks are often based on khabar, what the smart money is doing. And when he asks you about PSU banks, it's not surprising that on that same day PSU banks are also going up. So I'm just curious that when you just look at it theoretically, some things shouldn't be going up, but then you see that actually they are going up, and there is some valuation logic built into that which you probably don't agree with, because Pankaj asked you about PSU banks and you were not agreeing with the valuation logic there, and at the same time on our screen we could see PSU banks all up. So what happens? There seems to be a lot of money flow in Indian markets which are counterintuitive, which seem to be things that you can't fathom.
Right. Yeah, so see, my response is very simple. See, the thing is that you will have a situation where a lot of people will have a lot of ideas, and this market is comprising of different types of investors, and everybody has a certain theme to really play. What we basically do is to really look at what is where are you in the cycle, and what are the sort of ecosystem that you are placed within at this juncture, and see how it pans out going forward. So for instance, we were very clear right at the beginning of the year that this will be a year, at least next 1 or 2 years, will be a period when there will be a lot of focus from the government to reinflate the economy, boost the demand, etc. And we very, very clearly identified that there will be a large focus on consumption-oriented things. So we went overweight on consumer durables, autos, especially rural. We changed our stance with respect to the rural, especially after the budget, when my views were more consolidated in terms of what the direction of the market. So we know that there is a sort of fiscal expansionary intervention that the government has actually introduced, and we have to really look at what is the first derivative, second derivative impact of such policies. So clearly we are moving from some of the frontline stocks to the second rung ancillary stocks and the component stocks within each of these verticals. I think that is how one has to really play. As you understand that while this might be an opportunistic view, my view in the next 1.5 years could actually be different. But as long as that is playing, I'll have to play that, and I have to really identify components that can actually do well. For instance, if we were talking about two-wheelers, let's say Hero Motors and Bajaj, and let's say Maruti, we are talking about also about M&M, for instance. Then we look at what would be the second order. That would imply focusing on auto ancillary, for instance, people who make fasteners, dashboards, all the wires that are cables that are being used. So you have to really filter it down. So as long as you are in that trajectory of argument, you will get it right, and you have to really understand how long will this cycle go on. So that's the art that you need to learn, and there is a certain amount of predictive capability that one has to really rely upon.
Without beating about the bush, let me try and be absolutely direct about this question, because I was trying to approach it, I guess, from the flanks. I'm just saying that if I look at the seed companies, right? If I look at agri-facing companies and look at the 3-month return, these are the ones which have been talked about for the last 2-3 months. And if I look at the 3-month return, I would probably see 12% and a good one, somewhere 7%, 6%. And when I look at Unitech 3-month return, I get 65%. Now, I'm just curious, and I want to know that when we look at daily fluctuations, is the Indian market a little too shallow? Are a few hands able to move the stocks on a daily basis, and that can confuse our viewers into believing things are happening where they aren't?
Absolutely. I would agree with you 100%. So many of these, see, when you get into the eventual and ultimate phase of the buoyancy, essentially some of the stocks which were considered to be weak or tainted will actually do very well. In some of these stocks, the liquidity is not good. So the participation of 1 or 2 or 3 or a few investors can actually move the stocks very significantly. And since the market generally is in a buoyancy stage, people tend to ignore, and a lot of people jump into it as well. So the thing is that as we had seen somewhere around February, that when the market momentum started to fade and there was correction that was happening, some of these stocks corrected quite sharply. Some of them corrected almost like 70-80%. So the advice that we give to people is to really look at companies where there is a certain amount of fundamental visibility. You can't really get into we are saying we're not getting into stocks just because the market is buoyant. So there has to be a logic behind the thing that you're doing. So yes, many of these poor quality stocks will also do well.
Are you a little concerned about some of these consumer-facing stocks and how they're performing towards the fag end of the earnings season? I'll just take the case of, for instance, Jubilant Foodworks. We were speaking to the management, and they're saying that they said that July, August has been much better. But if I look at the Q1 numbers, they have been quite disappointing, right? Are you concerned that the consumption recovery that you were looking at, thinking of, hasn't really worked out like that?
So I think if you look at the various pockets of consumption, I think the performance have been fairly mixed. So for instance, if you look at auto segment, for instance, the companies are telling us, and at least from the conference that we did recently, that the urban space is looking better. It is looking better than the rural. Rural has been sort of facing a sort of a distress situation for quite some time. But what the companies told me is that there is a certain amount of pickup. So if you look at the auto numbers, for instance, those are pretty good. As far as jubilant food work is concerned, I mean, there are concerns with respect to the volume growth. Same-store sales growth has actually been in negative. So there is a certain amount of specific explanation for such companies, but I haven't come across significant evidence to suggest that consumption has been very weak. For instance, if you look at the GDP numbers that were recently published, the consumption demand has been pretty strong, and that's largely coming from government revenue spending. Also, if you look at the retail lending by banks and NBFCs, those are growing in excess of 20%. People are buying two-wheelers, people are taking loans against property, so there is a sort of utilization that is happening. Also, what we notice is that as far as mortgage loans and loans against property is concerned, it appears that banks and NBFCs are approaching tier 2, tier 3 cities, even semi-urban areas and rural areas to actually lend money. So there are triggers that are there which are sort of supporting consumption demand at a larger level. Company-specific issues are definitely going to be can be actually different. So I'm not very surprised with that.
So I'm going to come back to that specific point, because the last time you came here, I think there was an MK conference that you were coming out of where you'd spoken to a lot of companies, and you had done a lot of channel checks. I'm going to come back to that, but the argument partly that you're making, Saurabh Mukherjee of Ambit was on our channel, and he said that he feels that we are going to see a credit-driven consumer boom. That because banks really have nowhere to lend to, and the business of banks is to lend. And if they cannot lend to corporates, they will have to lend to consumers. And that is going to lead to a boom. If you agree with that, then is there anything that you would pick out in terms of specific stocks that you think will do well?
So I think that has been our argument as well. So if you look at the last 2-3 years, the point that we have highlighted is that the compensation growth of employees, if you look at BSE 500 companies or even listed space, what has happened is that the compensation growth for employees have actually declined to almost like close to the 25-year low at something like 3 to 5%. And that is growing substantially lower than the consumption growth. So overall consumption growth could still be growing at, in nominal terms, somewhere around 9 to 10%. And lending growth is growing at something like 18 to 20% for banks, and for NBFCs in excess of 25%. So clearly there is a sort of a significant structural shift in terms of ability for the households to actually leverage. That in a context where in the future that there will be a seventh pay commission, there will be a certain consumption revenue spending that the government will do, that the ability of the banks to actually leverage households can actually increase furthermore. So my sense is that banks and financial institutions and companies will continue to push retail lending, especially in the context where the corporate lending has been flagging, and there is no appetite for investments per se. So per se, there will be a significant increase in retail lending. The difference between 2007 and now is that now you have many more players compared to what you saw in 2007. In 2007, the compensation growth was growing at something like 25-30%. Right. So there was a significant significant support for a retail lending that time. Right now, you will have NBFCs, you have microfinance companies, you have banks, and all sort of companies who are doing retail lending. Essentially, the ROAs for lenders will also decline. So, this is going to be a situation where you will have a sort of a further expansion in retail lending, and lenders will not be able to make much money. So that is what is going to happen. As far as how we play this, we have already identified. 8-9 months back, we were talking about two-wheelers, autos, etc. Those things will continue to do well. So durables also something that we had actually identified. So I think The argument that you're referring to is something that we have been playing for almost like 9 months. We have considered, we have continued to, build
You
up
hold
upon
on.
that, and we have gone into the second order, third order kind of implication now.
Okay.
Yes.
One of the things that we've seen that despite the fact that we don't have operating leverage, that we are operating at low, capacity utilization across the board, even with a minor improvement in demand and minor improvement in capacity utilization, cement companies have already raised prices, and they seem to be envisaging higher increase in prices, especially in the north market. What I want to know is that if demand is going to be driven by credit, there is going to be more demand, people are going to buy, corporates are going to get pricing power, especially consumer. That should increase inflation, right? Which in turn should increase the interest rate.
Yes. Yes.
So I'm saying that
Yes. So, see, the thing is that, when I spoke to your channel in January, I came to your studio, and the reason why we changed our view is because we saw somewhere around December, Arvind Subramaniam had actually mentioned in his mid-year economic review that the government should actually, or policymakers should actually work towards increasing the nominal GDP, and it was very clear that that there was a sort of argument against continuing with fiscal austerity. So I could very well see that there is a policy shift in favor of higher nominal GDP growth, and that comes with higher inflation and with higher fiscal expansion. So fiscal expansion translates into higher sort of a multiplier, especially when it is revenue spending and consumption spending. And as that happens, the whole idea is to actually reinflate the economy, and you as you see it, the CPI inflation has gone up from somewhere around 4.5% last year to currently about 6%. So that's a 150 basis point up as far as CPI is concerned, and WPI from an average of minus 2.5% has gone up to 3.5%. So there is a 600 basis point increase in the WPI inflation. So if we move further into this, while there might be some movements in the short term up on the upside or downside, but by and large, what we have found is that nominal government spending, especially the revenue spending, has a significant impact on the CPI inflation, and for every 10 percentage point increase, there is a 3 percentage point increase in the CPI. So clearly, from last year, the revenue spending will be growing from something like 5% to something like 15-16% this year, if you consider what is allocated in the budget, and also the impact of the 7th Pay Commission and other things such as increase in minimum wages that the government is actually talking about. Yeah.
And also,
so
there are several elections coming up.
There is an effort to reinflate the economy. There is an effort.
I'm saying there are several elections coming up, crucial.
Yes.
There's UP.
So, I do expect that there will be. Yes. Correct. So the thing is that there is a significant focus on the farm sector. The government has already promised that we'll need to double the farm income in next 5 years. That implies that you will have to ensure remunerative prices for the farm sector. All those things will happen. And also from a global standpoint, if you look at it,
I'm just interrupting you there so that you can hold on to that thought and give me a little bit more on that. Is that what you're saying effectively to me appears that while income growth, I mean, let's say an average corporate executive, a guy who carries his lunchbox to office and has an increment at the end of the year, last 2-3 years or last 5-6 years, he's not really seen real income growth, or has seen very minimal real income growth. Now we are saying that he's going to get easy credit. He's getting those calls, sir, aapko loan lena hai. He might succumb sooner or later, take that call and buy a new car or upgrade his car. The point is the ability to pay is also dependent on your balance sheet, right? In a sense that the income that you have, the savings that you have. So the initial downward trend that we're seeing in interest rates, one, inflation crosses that 6% level that the government, the MPC seems to have set, that then there cannot be any further reduction in at least the nominal interest rates that you're going to see. And therefore, the ability to pay loan, pay back EMIs gets more and more difficult for people. So we'll see that again, that cycle coming in probably sooner than we expect.
See, the thing is what I would assume that at some point of time that will be that will re-emerge as a worry, as it did in 2008-9. So the thing is, before that happens, it can actually increase even further. So what we are basically looking at is the multiplier effect of fiscal spending will translate into higher leveraging of household, at least in the next 1.5 years. The key thing is that the pace of growth in lending is growing faster than the increase in or growth in compensation, or potentially or even potentially it may grow much lesser. So let's say compensation growth can increase from 3% or 5% to something like 10% or thereabout. The lending growth is growing even higher, at 20%, 25%. So the lending growth, I guess, can actually speeden up further than the compensation growth. So that is one angle that I'm keeping in mind, and hence there is a sort of inherent risk of default even in retail lending. What banks and NBFCs and especially banks have done is to actually increase the lending, especially for mortgage backed portfolio. So and also loans against property. So essentially, the whole boom in the property market that we saw in the past 10 years is also being leveraged by the banks to ensure that there is considerable collateral, so that whatever lending that they are doing doesn't quickly translates into default. So that's one thing. But I think what could happen in the second phase is that you will have more durable lending against durables, autos. You will have more uncollateralized lending as well. So I think the profile of risk could actually increase going forward. What we have also understood is that even if you consider the mortgage lending, the spread between, if you consider SBI for instance, the spread between the marginal lending rate or the base rate and the mortgage lending rate is actually very little. So the spread is actually declined and it's almost close to zero. So the thing is that the risk of default or risk of liquidity is underpriced at the current lending rate. So clearly there is an inbuilt risk that is still there.
All right, Dhananjay Sinha, thank you so much for joining us. Hope to see you back soon, because there's a lot to discuss and things will develop, and we would really want to pick your brains on that.